Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Okay, in this particular video we are going to be diving into scalping chart patterns. All right, we're going to be looking at scalping chart patterns. It's a crucial skill for traders who want to take advantage of short-term opportunities in the market. So whether you are a beginner or an experienced trader, understanding these chart patterns can greatly enhance your scalping strategy. So in this video, we'll try to cover the most important or the most popular scalping chart patterns, how to spot them, and how to use them effectively in your trades. Okay? If you are ready to take your scalping game to the next level, make sure to stay tuned and don't forget to like and subscribe for more trading tips and strategies. Before we get into the chart patterns, let's quickly go over what scalping is. All right. So scalping is a trading strategy where traders aim to make small profits by executing quick trades throughout the day. Now, the goal is to capture short-term price movements, typically within minutes, right, and close out trades before the market has a chance to make significant moves. Now, scalping requires fast decision making, good timing, and the ability to identify market opportunities quickly. This is where scalping chart patterns come into play. Now, there are visual formations on the chart that give us clues about where the price is likely to move next, helping us decide when to enter and exit trades in a very short time frame. Okay, scalping chart patterns are visual representations of price movements that help traders predict future price action. Now, these patterns form on smaller time frames such as the 1 minute or 5 minutes or even the 15 minutes chart. Okay, and they are typically used for ultra short-term trades. Okay, now the most common scalping chart patterns include triangles, flags, and pennants. Each of these patterns has its own unique characteristics, but they all share a common trait. They help traders identify when the price is likely to make a move, allowing them to enter trades with precision. So let us break these patterns down and discuss how to spot them. Let us start with triangles. All right, let's start with triangles. Now, a triangle pattern forms when the price moves within converging trend lines. For example, this converging trend lines. When you connect the highs and connect the lows, you connect the highs, right, and connect the lows, and you notice that the trend lines are converging, you have a triangle. Okay, as the market consolidates, the range gets tighter, as we can see, and as the market consolidates, the range gets tighter, and this signals that a breakout may be coming soon. Now, there are three main types of triangle patterns. We have the ascending triangle. Let's see if we can find that. It typically have a flat top, and an upward sloping bottom. That's an ascending triangle. Okay, we can see we have an ascending triangle around here. A flat top and an upward sloping bottom is what we call an ascending triangle. Okay, it's a bullish pattern. It suggests that the price is likely to break higher. And you can see we actually had an upward breakout eventually, right? Now, secondly, we have descending triangles. Okay, let's see if we can find that. Descending triangles has a flat bottom and a downward sloping top, right? It's a flat bottom and a downward sloping top. Let's see if we can find a descending triangle. Okay, I think we have one here, a flat bottom and downward sloping top. Can you see just within this zone? Within this zone, we had a descending triangle, right? So this one is actually a bearish pattern. Okay, it indicates that the price may break lower. Then we have symmetrical triangles. These have converging trend lines with both the top and bottom sloping toward each other like this. This is what we call a symmetrical triangle. Okay, a breakout could happen in either direction, so it's important to wait for the price to break out before entering. Now, in scalping, triangles are valuable because they show us a consolidation phase, and traders often see sharp price movements once the breakout happens. For example, you can see what happened here, right? Now, when you spot a triangle, wait for the price to break out of the pattern and confirm the direction before entering a trade. Okay, next, let's talk about flags. Okay, that's the next pattern we're talking about. Okay, let's talk about flags. Now, a flag pattern is a short-term consolidation that follows a strong price movement. All right, it looks like a small rectangle or parallelogram that slopes against the prevailing trend, and it often forms after a sharp price move. Now we can see what happened here. You can see that we had a sharp price move, and then we had, a sort of, pattern coming down like this. Can you see that this resembles a flag? If you look at it carefully, you can see that it looks like a flag, right? The flagpole and the flag itself, right? So, as I said, it looks like, a small rectangle or parallelogram, like what we have here, that slopes against the prevailing trend, because this is the prevailing trend and this is the slope against it. And it often forms after a sharp price move. So this sharp price move is actually what we call the flagpole. Now, there are two main types of flag patterns. The bullish flag pattern is, it forms after a strong upward price move, like what we have here, followed by a downward sloping consolidation, like what we have here. Now, it breaks out to the upside after the flag formation signals that the bullish trend may continue. All right. On the other hand, a bearish flag occurs when, after there is a sharp decline and, a sharp decline followed by an upward sloping consolidation, just the opposite of the bullish flag. Okay. And a breakout to the downside signals that the bearish trend is likely to continue. Okay, now flags are usually useful in scalping because they represent a brief pause in a strong trend, and once the flag is complete, the price often resumes in the direction of the original trend. All right, so as a scalper, you would want to enter the market as soon as the price breaks out of the flag formation. So this would have been a good place to enter a buy. Okay, now let's move on to pennants. Now, pennants are similar to flags but are much smaller in size. Okay, they form after a strong price move and have converging trend lines that resemble a small symmetrical triangle. Okay, let's see if we can find a pennant. Now, the key difference between a pennant and a flag is the pennant's more compact size and the fact that it typically forms after a larger price move. Okay, so if we don't exactly find the pennant, I might just indicate with a diagram, right? Remember that a pennant and a flag are somehow similar. All right, it's just that the pennant forms after a larger price move, and it has a somehow symmetrical triangle looking feature, right? So as for a bullish pattern, I can't exactly find a pennant right now. But as for a bullish pattern, as for a bullish pennant, it forms after a strong upward movement, right? Followed by a small consolidation. You might see, a little consolidation, right? And then the price breaks higher. So you might see somewhat like something like this. You might actually see something like this, and then you're going to have the price break higher. That's for a bullish pennant. Then the bearish pennant is just going to be the opposite, right? After a downward move, you can have a consolidation to the upside, and then after that, you're going to have, a downward break. Okay, so pennants are great for scalping because they indicate that the price is pausing briefly before continuing its previous move. As with flags, you would want to enter the market after the breakout and follow the original trend direction. Now that we understand the most common scalping chart patterns, let's discuss how to use them effectively. Now, the key to success with scalping chart patterns is confirmation, right? It's important to wait for a breakout or a clear signal before entering a trade. So here's how you can use these patterns. First, you have to look for clear breakouts, all right? Look for clear breakouts, okay? Never trade the pattern until the price has broken out of the consolidation zone. Now, you want confirmation that the price is moving in the direction of the pattern. And then you can actually decide to, check out for volumes. A breakout with high volume adds more weight to the signal. It shows that there's strong interest in the direction the price is moving, increasing the likelihood of success. So you can actually decide to add volume indicator. For example, right? You can see that at the site of the breakout, there was an increase in volume. So volume you can use volume to check if the breakout is valid. And keep your time frame small. Since scalping is all about quick trades, focus on shorter time frames like 1 minute, 5 minutes, and 15 minutes. Okay, this allows you to spot patterns and enter and exit the market swiftly. Okay, and then finally, risk management is very important. With scalping, tight stop losses are crucial. The goal is to get in and get out quickly, but also to protect your capital if the market moves against you. Now, combining these tips with the chart patterns we discussed can help you make more informed and successful scalping trades. Before we wrap up, let's quickly go over a few common mistakes to avoid when using scalping chart patterns. First, trading without confirmation. Jumping into a trade too early without waiting for the breakout is a recipe for failure. Always wait for the market to confirm the pattern, okay? Secondly, ignoring risk management. Scalping involves quick trades and the market can move against you fast. Always use tight stop losses and proper position sizing. For example, if we enter the buy after this breakout, a tight stop loss means the stop loss just below the breakout point, right? And then, so long as that point you are setting your stop loss is a valid point, below the breakout point is actually a valid point, because if that breakout is legit, it's not supposed to get back into, the price is not supposed to get back into the consolidation again, all right? So, another mistake to avoid is overtrading. Scalping can be tempting because of the fast-paced nature, but don't overtrade. Stick to the setups that meet your criteria and avoid forcing trades. By staying disciplined and following these guidelines, you'll increase your chances of success with scalping chart patterns. Now, to sum it up, scalping chart patterns are a fantastic tool for traders looking to make quick short-term trades. By understanding patterns like triangles, flags, and pennants, and combining them with good risk management, you can improve your scalping strategy and make more informed trading decisions, okay? If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and leave a comment below with your thoughts or any questions you may have. Thank you for watching, and I will see you in the next video.